So they were just talking about the coronavirus. So we can talk about the short-term outlook on global equities and longer-term and the structural issues that we're seeing, what you're seeing. But short-term right now, obviously the markets are looking at this coronavirus with some trepidation. Is this an opportunity that investors are seeing to maybe cash out because valuations have gotten a little bit high? Or is this genuinely a concern that we're revisiting possibility of SARS?
Well, I think the concern is clearly there because there is a precedent, and that was a difficult period, of course, context slightly different. But it's a very difficult thing, of course, to predict where it goes and how long it lasts. And obviously, we all hope for the best, but the markets tend to react very quickly to this, hitting the areas that are most likely to be at the epicenter of it or most sensitive to it. And I think, as you say, it has to be seen also in the context of how much the markets have run up quite recently. Right. So it's one of the sorts of things that I think could lead to something of a correction. Yeah,
and there's been a case now in Washington State, so it's gone onshore to the United States, so maybe also in focus there as well. So where do you see 2020 going? When we had the high P&Es in the late 2019, you still see momentum going for U.S. stocks, but not as much room to grow?
That's right. I think the context is important here. Remember, last year is an interesting year because the beginning of it was the trough of effectively a bear market at the end of 2018. Then we had a change in Fed guidance. Most people had expected rates to be rising through last year. The Fed ended up cutting rates 3 times, and that helped to stimulate a big rebound. Global equities were up, remember, about 25%. That's roughly 4 times the long-run average. Interestingly, with only about 80% of the average volatility. And nearly all of that rise last year came from multiple expansion. Profits were quite flat.
So what kind of growth can we expect in 2020 when you do have added risk of a U.S. presidential election, which is a complete wild card, but you have those higher multiples now?
Yes, you have higher multiples, and that would imply, and we believe, lower returns moving forwards. We also, importantly, do expect relatively modest profit growth this year, better than last year, but roughly in most markets in the sort of mid to high single digits. We think margins have generally peaked, and that's really what's going to drive profit growth. And without multiples rising, that gives you the sort of mid to high single digit type growth rates that we would be expecting.
Then what would be your advice to clients who are too top heavy U.S. equities? Diversify overseas?
Yes, an important point again in terms of perspective here. Remember, in the last decade since the financial crisis, one of the key themes in equities has been the dramatic outperformance of the US. Now, that's made good sense because US has seen much stronger earnings per share growth. Give you a sense of this, if you go back to before the financial crisis, the last peak in earnings per share, 2007, S&P earnings have grown roughly 90%. Over the same period across Asia, roughly 15%. In Europe, only around 5% cumulative earnings growth since then. The differences are partly reflective of different sector exposure. The US has been very concentrated in technology, which has done very well. But those differences have really explained the outperformance, and we don't expect similar superior earnings growth in the US this year and next year. So that would point to more diversification.
So where should they be adding in Asia? We just got great numbers from Taiwan. That's a cyclical uptick, though, in the chip cycle and investment cycle. Also, there's been onshoring of manufacturing as a beneficiary of the global trade war to a non-tariffed location, basically. Taiwan was very benefit. Maybe it's sitting in isolation, but South Korea was just out with very good quarter-on-quarter GDP growth. The chip cycle, Samsung telegraphing that the chip cycle's on the upswing. So where in Asia would you...
Well, I think Asia generally is a more cyclical, higher beta market in the global context, along with actually Europe and Japan as well. The US tends to be more growth and growth defensive. So all of these markets should benefit, and indeed have benefited, from this uptick in optimism. We're starting to see some of the macro data coming through. In Asia, as you mentioned, we saw some decent industrial production numbers in China too. Leading indicators in the US and Europe are also starting to pick up. We think the Chinese market, which we've been positive on for a long time, is also looking quite attractive given valuation. So I think there's upside across Asia for this year. We don't think it's huge, and we think that in the context of the high valuations at the starting point in equities generally, markets will be sensitive to upsets, whether they be political, And we wouldn't expect to see such low volatility this year as we saw last year.
Are the headwinds associated with trade taken away by the Phase 1 trade deal, or was that the low-hanging fruit? That was an easier deal to be done than the structural issues that have to be tackled possibly in Phase 2 and further down the road in 3.
Yeah, I think that's a very good point. We think that the escalation has peaked at this stage, and that's a good thing. Markets have absorbed that in a positive way. But we don't think that's completely clears the field in terms of tariffs, and there's some difficult further negotiations to come. How that goes will depend, of course, on the political context in the US as well. But for now, I think at least we've seen probably the peak of that tension, and that should mean that you get a recovery in some of the manufacturing data that has reached quite depressed levels at the end of last year on a global basis. And again, that's fairly supportive of more cyclical assets.
You're positive on China. Would you be a little bit cautious, though, going into the Lunar New Year holiday, given the overhang of this concern about the coronavirus and the like? I mean, we're already seeing the possible drag on retail sales, on catering during the holidays, et cetera, and the human migration, which is important.
Very important. And I think you're right. Again, from how much markets have run up, they're all vulnerable to a correction from any disappointment in the short run. But, and we're seeing a little bit of that volatility now. That's why in aggregate over the course of this year, we don't see that much upside for equities. But importantly, we do see them making progress in the context of this economic cycle continuing, bearing in mind that in the US in particular, this is already the longest economic expansion,
getting long in the
150 years.
Yes.
Is likely to continue. That is likely to generate higher profit growth and better returns in equities than other asset classes.
I've been here at this conference 2 days and I haven't even mentioned Brexit. You were telling me before the interview that you think there's a little bit more confidence in the UK right now.
Absolutely. I think there is. We've seen some inflows in terms of fund flows into the UK after a long period of outflows. The actual macro data remains very weak, but that's largely historic. There is likely to be quite a big fiscal boost in the UK following the budget in the next couple of months. And I think from a sentiment perspective, having a government that can get things done because it has a majority, and also the clarity of actually getting the withdrawal treaty through Parliament, and therefore, in a sense, getting Brexit done, although there's still, again, lots of negotiations to come in terms of the trade agreement. The sense that it is being done, I think, allows people to sort of refocus and also provide a little bit more confidence. And we're seeing that in some of the nearer term confidence data.